Hey guys, super happy to be here once again on our show, the TradePod. And today I'm humbled and grateful to have Eyal Inbal. Eyal is one of the well-known investment bankers here in Israel, and we're here to talk about the economy for entrepreneurs nowadays, for fundraising, which is uh, typically a great change for what we're usually discussing here, but it's great to know the macro about what's happening in nowadays markets. So it's a great pleasure to have you here, Eyal. I'm super happy to talk about different subjects that we're usually talking about, which I think it's a great refreshment. And yeah, it's a pleasure. How are you today?
Hi, Afek. Thank you for having me on your podcast.
It's a
Uh,
pleasure.
Great to be here.
It's a pleasure. Now, before we'll start, I would love if you can tell to the listeners a little bit more about yourself, so everyone will know you properly good.
So, as you mentioned, my name is Eyal Inbal, and I run an investment banking corporate finance company called EIBD, which is basically working to raise capital for startups and technology companies for all types of stages. I mainly focused on the early stages. However, I'm also doing capital raises for later stages.
Hmm. You know what? Let's dive deep into the conversation, and let's make it much more fluent. As an investment banker, I would like to ask you what's the biggest different factors that separates companies in their early stages to companies in a much more advanced stages, and how being an early stage ease or make the fundraising process much more difficult, or conversely, what's the differences between raising capital to early stage startup to later stages startups?
It's a great question, Afek. Um,
This
Initially,
is
yes,
this is what you chose to spoke about.
yep.
This is not about
So,
myself.
yep. So, well, it's an interesting question. Definitely, let's make some order. Early stages for startups who wish to raise capital are considered the pre-seed, pre-seed stage, seed stage, and in general, round A stage. So startups which are coming to raise capital, they should have some advancements in their progress on in their roadmap in order to meet certain milestones that will enable investors to look seriously at their companies. So usually startups at the pre-seed stages are already having some kind of a product or service, usually a prototype or an alpha or beta type of software if they do software, or if they've developed other products, and they should have something already to present as running, meaning that they already passed the stages of validation and of uh, having the certainty that their innovation is indeed working. Uh, I just want to limit what I say. It very much depends on the sectors in which the specific startup is operating,
Of
because
course,
every sector is looked
slightly
differently
different.
among investors. A startup which is in a deep tech sector or in the pharma sectors, these are two sectors, or semiconductors, for instance. These three sectors, for instance, are known for the long term that it takes to have validation to the technology. So in that respect, also the early stage, the pre-seed stage or the seed stage can be prolonged compared to other startups that come from different sectors such as mobile applications or SaaS or medical technology. So it varies very much specifically between each startup and the sector. But the challenge is always to raise money to the early stages startups because the risk and the uncertainty whether the startup is indeed going to meet its milestones and follow the roadmap that the founders stated they would is uncertain, and therefore investors know it, and it is a very difficult period for the startup to get funded. If you look at Israel, this is a major market that I'm operating in. Startups in the early stages have quite limited sources to get funded. When a startup is being established and the founders seek capital, they usually go through the earliest stage, which is called FFF. Why it's called FFF? Maybe you know the term of it. It's family, friends, and
No, I
fools.
don't.
Family, friends, and fools. This is the time
Mm,
when the founders usually bring some equity from home, some savings that they have, and they get some friends which believe in their idea to come and join them, and some other private investors usually that might fall in love in the idea or in the startup and give some money to have the startup get going. This is a very early stage. Usually startups raise around 300, $500,000, maybe up to $1 million. And this allows them to have some time to check the validation of their technology or the service or the product which they are basically doing. And once, as mentioned before, this comes to maturity, they go to raise the pre-seed. And as I said, raising a pre-seed is, I would say, extremely difficult. And unfortunately, I meet a lot of founders from a lot of startups coming from all sectors, and they don't pay much attention to thinking on how they're going to raise capital. And why is that?
why it's important?
Why it's happening? Um,
No, why it's important at first? Why does the founder needs to think in advance and how he needs to raise capital? What's the importance behind it?
Look, at the end of the day, a startup is a business, and business needs cash to get going, and it needs to get money. And if the startups don't have a solid backup to support its financial needs, then usually the startups get to a dead end point. And the smart investors think about that fact, and they do care about getting capital parallel to their effortless, effortless steps in developing the technology. And sometimes they are so busy in developing the technology and thinking about the product that they don't pay attention to the fact that basically they're going to run out of cash and they will be stuck to get finance to reach the next level. And look, money is rare product when it comes to venture capital. I don't know if you know, but I will ask you, Afek, how many startups do you believe that get capital in percentage?
I would assume that it would be 7%.
Can you repeat?
7%.
Yes, you're right. It's around 7 to 8% of the startups get funded. And
I need to fill out a lottery today if I'm right with
exactly. So
this percentage.
it's amazing. Startups founders are not aware of that statistics, and it means that 92% of them are unable to get funded. So what happens to these startups? Uh, Great people with great minds, creative, educated, experienced. They put their lives into forming a startup, and they get to a dead end. It's called the death valley. It's when the startup unfortunately comes to a dead end that it cannot um, get funded in order to support its effort to go on with its roadmap. And that a lot of time happens because of the lack of founders to understand the situation and pay attention to it. If you look at the successful startups that you read about on the newspapers, you always find you will always find founders which have on the one hand the technological abilities, meaning that they know what they do, and on the other hand they have managerial skills, business skills, and in that respect funding skills, and they combine it together. And I meet a lot of startups, unfortunately, that they don't think about that side of the equation, the financial side, or sometimes they have unrealistic.
Why it's so impactful? Like, listen, I heard a lot of startups who raised an incredible team, um, full of capabilities, both technological and business capabilities. Um, and I noticed that without any further raising uh, knowledge or even experience, they're able to raise by their names or by their past experiences, which really ease the decision for the investors. That's what I've done with my startups. And I think it's rarely impactful um, over the investor side because when they see your capital your cap table, they're instantly think about the capabilities of the team to actually fulfill the mission that they all gathered about, which I think um, slightly better than coming onto an investor without having a much stronger team. Um, there's to my mind and about my experience, I think there are major components that really ease the decision for a few investors that you might meet over the journey.
It's a good point, but I'll ask you a question, or I'll give you some data. In Israel, in each year there are around 500 to 800 new startups being established. There has been some decrease in the last 2 years because of objective reasons in Israel.
Yeah, we
The-
all understand.
There was this allegedly reform by the government that chase away some founders from erecting new startups, and then unfortunately the 7 October war, and that took some of the statistics down. A lot of the startupists were in the army during the war. So the market was a bit slowed down in terms of new startups joining. But we can assume that around 600, 700 startups have been established. And by the way, some of them were established abroad in the US from all type of reasons. it's not good tax-wise, but in other ways, it's better for them. I think opposite. But anyway, you said how many founders are really famous or really have a name, and people would follow them almost blindly and give them money to support their startups. So you read about the extreme or the outstanding startups which founders are already known and they've made some success exits before. And then they pick up the phone and they say, look, I'm having a new startups, and they have a line of investors waiting to take a number to join their startups. But these are diamonds. These are scarce. This is an illusion. This is not the real world. For instance, if you take Wiz, which is a good example, its founder Asaf Rapaport and the others were already having few startups which exited. They have extraordinarily past Rapaport in managing Microsoft. So he's not an example for raising capital. The majority of founders are unknown. They are good in their area. They know what they do. They are experienced, but they're not famous enough to have a phone call and get them funded. Now, it's a big difference if you need a few hundred of thousands of dollars just to start rolling, or if you're now in your seed stage and you need $3 to $5 million, and then you basically need to go and be more professional in getting funded, because let's think about it. How many acquaintances you know? Supposedly you will run now a new startup. So let's assume that you know 30, 50 people, which is a lot, by the way. It's a lot. But let's say 30, 50 people which you met along your career, and you think that they might tend to maybe consider investing in your startup. But when you come to talk to them, some of them don't have money at that point. Some of them have already invested. Some of them have other priorities. Some of them are not interested in your sector, in the field where your company is operating. So it's a lot of luck and timing, of course, to get funded by friends or by acquaintances or by people that introduce you on a personal level, investors. And this is something good to have, but it doesn't necessarily guarantee that you will make money. Sam Altman and Elon Musk, if they now have a new startup that just pick up the phone and can get billions in no time over some phone calls. But how many startupists unknown are able to do this? So I'm
So
working
what do
with
you do?
those.
So what do you do? Before speaking about those diamonds, you mentioned that usually what happens is that they build a prototype or they build a substantially good team and they're able to raise their pre-seed. First, I would like to ask you why does a pre-seed is so important for a startup to raise? And first of all, let's mention the difference between a pre-seed round and a seed round and what you need for both of them. And what are the difficulties among raising pre-seed and seed for a company and how to successfully pass them through? Because if you're not properly prepared, as we speak about the situation exponentially in the Israel market, you would not be able to raise. So first of all, let's dive deep into the difference between a pre-seed and seed and what you need to actually be prepared for those rounds, how to make the right calculations in order to pass um, in a successful manner those funding rounds.
It's a good question, Afek. First of all, by definition, a pre-seed round, generally speaking, is a round where the investors need to raise capital of around $1.5 to $2 million. that's the borders of the round. It's a round, as I mentioned before, that the company has already got a running product, a prototype, or an alpha or beta version of software or of its technology, and they now need the money to complete R&D just before getting to the market. The seed round is usually around $3 to $5 million, and this is the round just before going to the market. Actually, you must have some signs that the market is ready to buy your product. And this is what investors want to know, that really you are doing something that has a market. So it's very common to put on presentations the addressable market and the target markets and the sellable markets and show big numbers. But when you come to perform this, then it's much more difficult because this is real life. So the paper, you put something on the paper, it sounds good. But then when you come to actually exercise this, then between the expectations and the performance, there is a usually big gap. And some say there is no connection between expectations and performance because a lot of things happen in the middle. And investors know it. So when they come to invest in your company as a startupist, they have expectations, but they're really, really with their finger on the trigger to make sure that things are moving on the right direction. And this is why it is very difficult to get funded at these stages. By the way, in Israel, there are around 562 VCs. Last time I counted, most of them, if
This
not
is
all
an
of
enormous
them,
number.
most of them, if not all of them, will not invest during pre-seed and seed rounds. They will be very nice with you. You'll go to meet them. They will give you the respect. They will want to hear what you have to say if they invite you to a meeting. And they will usually tell you, okay, it's very interesting, it's very nice. They'll tackle you with some questions, and then they'll tell you, okay, let's follow up. Let's meet a bit later when the company already has some sales indications of start selling. These are most of the VCs, most of them. Some of them do take a chance and invest in the early stages, but they really need to be very much assured that the technology and the team, of course, are able to perform. And it's very difficult because it is based on a lot of predictions rather than results. And that's the main issue. So this is the difference between the pre-seed and the seed in the numbers and in the maturity of the product. Now, again, it very much depends on the sectors that the company is active in. And it's a major factor. Give you an example, for instance. Israel is very creative in the healthcare sector. And healthcare sector, it's a very big sector in Israel. Just to give you an idea, you have the biotech and pharma and the drugs and medical devices, medical technology, digital health, services to the healthcare sector. And all of these subsectors have many, many subsectors underneath that investors are looking at and have interest in. And for some sectors, you have more investors that you can apply to in order to get funded. And some sectors have very few investors. If you take, for instance, water tech in Israel. Okay, water is a very big problem worldwide. Actually, water is rare in some places, and there are water tech companies in Israel. not so many, but enough. And there are only 2 or 3 funds in Israel which basically fund water tech companies. So imagine that all these startups in waters, they all know each other, and they have only 2, 3 few venture capital or investment companies to come to and ask for funding, which is extremely, extremely difficult. So then they must go abroad. They must expand to the international markets to get funded by international investors. So Israel, as much as it is a startup nation, in terms of investments in the market, it's only 7th worldwide. And something very important, if you look at 2024, for instance, there's been a rise in the amount of startups that got funded when you compare it to 2023.
Mhm.
Actually, 38% more money came into the market. It's around 10 billion compared to 7, but out of this $10 billion, roughly 1 billion is basically was injected to a cyber company which is registered in the United States, belongs to an Israeli uh, startupist. So actually, it's 9 billion, and most of the money went to later stages rounds, which means that it leaves about 40% to the early stages, which means the pre-seed, the seed, and round A rounds, which are early stages. So then you get few dozens of companies which get money. The numbers are around 50 companies, 60 companies which got funded. And what about the rest? How do the rest
The,
get
the
money?
numbers the numbers are crazy. The numbers are crazy. What I think those who are not able to raise money, they they might not count my investors. And unfortunately, entrepreneurs tend to fail over and over and over again because at some point, even if what they're doing is substantially good, they're not able to raise money because the lack of interest by those investors. Um, and and I really think it's a matter of timing, you know. You
Well,
mentioned
here
that
I
FinTech.
disagree with you. Here I disagree with you.
Why?
Um,
Why
that's
is that?
that comes to the point that I mentioned that that you need to be a professional to raise capital. It's not enough to pick a phone to some people you know and pray that some of them will come to invest. You know, the world is not based
You
on
obviously, you do not need to do that. Do not need to beg for someone to invest in your startup, but you eventually need to persuade them properly.
definitely yes. But what I was referring to is that because the percentage of companies which are able to get money is so low, it's 8%, it means that you have to increase the probability of getting funded by being introduced to as many investors as possible and worldwide. And for this, you need to be helped. And in order to prepare a startup to get funded, there are some major things that need to be done before you are even offering the startup to investors. I don't know if you know, but ask a question. How much time do you think that an investor is dedicating to read an investment offer?
Few seconds.
No,
No,
it's
a
not.
minute. A minute. A
No,
minute.
actually, investors dedicate around 2 minutes to review an investor's deck. So trust me that all the investors deck I get from potential clients or leads which I talk to that think about my services, I would say almost 100% of them are not ready to go to investors because they don't follow basic rules of how an investor presentation should be made. And as you mentioned, investors get so many offers during a year to invest in all type of investments. They cannot just sit down and analyze what does this startup want to tell me if they take a deck to their hand and then they are unable to understand or grasp what it's all about. Sometimes I look at the decks and I read it over and over 2 minutes, that's for sure, and I don't understand what the startup is doing, why it is doing it, why now it is doing it, what's its roadmap, what are its basic financials, who is the team. I get some shortcuts to a LinkedIn page. I don't have time to go now surf the LinkedIn to find out who is behind the startup. I want to see it in my own eyes. So what I'm saying is that they make elementary mistakes in the way that they present their companies, and they lose a lot of traction, and they lose a lot of potential investors. This is my recommendation to all the startups. Before you're going to raise capital, you must do a very profound preparatory work. Startups should have a very good one-pager teaser, and one page is one page. It's not two and not three effect. I get one-pager teasers that have 4 pages. This is not a one-pager teaser. And startups should know to prepare a investors deck, which should be no more than 15 slides, maybe 17 with the back page and the front page. And they should have a good pitch deck for the meetings. The worst mistakes the startups do or startups do, they finally have a meeting with a VC or a private investor or investment company, and they open the the meeting and they say, okay, let's review the deck. No, thank you. If I'm a serious investor, I don't need now for you to read me the deck. I know to read myself. I learned to read and write a long time ago. Don't review the deck. I want to ask questions on your startup. So actually, startups should be ready for their intro calls with the investors with a very short pitch deck, no more than 4 or 5 slides that they discussed and they talk about, because you want to have an open conversation with the investor. You don't want to lecture him what is your startup or start to talk too much on your technology on a basic intro meeting. It's not interesting for the investor at that point. And obviously, startups should have a good financial model. They should show to investors a model based on 60 months for the next 5 years, how their startup is going to perform. On the one hand, they should have all their expenses, CapEx, OpEx, market cost, staff, R&D, etc., G&A, of course. And on the other hand, they have to show the revenue model based on their business model. How is it going to make money? When is it going to make money? When they foresee the the next revenues. And once they have this model, they will have a cash flow and a balance sheet and a profit and loss report. And the cash flow report is the most important for investors. Do you know why?
Mm-hmm. You really mentioned
No, but just want to finish what I'm saying, because investors want to know when the money is going to end, or how
yeah,
long is the money going to support the company, when they have to
I
start raising the next round.
I was about to say that a really eager about the things that you're mentioning here because um, it all happened within my journey, and it will, and I think it will happen over and over again for many, many, many entrepreneurs because this is, the pinpoints that you really need to notice when you're running a company and when you're starting something. And you're substantially correct. Now we spoke about why people or why entrepreneurs tend to where they would fail the majority of the time. Now I think that I would ask you as an investment banker on how to avoid being mistaken again and again after after a long period. Like how to stop being mistaken each and every single time and learn from your mistakes in a proper manner that would help you to survive longer.
Well, I can of course comment to this question on the funding side of it. Okay, because technologically, a lot of the companies fail to succeed technologically. The innovation is not innovative enough. They don't show any differentiation from their competitors. Sometimes they are another me too to the market. They don't have anything which is a tiebreaker to show, and they find it out once they are engaged in developing the technology or services or product, whatever. So sometimes the market is not there, and the product is good, and it's a good idea, and it's a good to have, but it's not a must have. Usually, the good startups which succeed are they have a product which or a technology which is a must have, and this is what drive investors to invest because when an investor is hearing the story of the company and he says, "Wow, how didn't they think about it before? What a brilliant idea! What a creative idea!" Or wow, I have the feeling that this startup could really succeed. It's because the startup has something to offer, something new, and sometimes startups simply don't. They have maybe good products, good services, but they don't have the wow. They don't have the something to be imaginary or to throw a big vision forward. So that's something that startups should have. Nevertheless, not all the startups are brilliant, meaning not all the startups do something that is a wow, but they do something which is very innovative, which is very important. For instance, if you look at medical technology companies, okay, or at medical device companies, they develop some extraordinary devices, tools that help medicine and help big population of patients. And sometimes, because lack of money, they are unable to provide the product to the market. They are unable to develop the product. So let's say that a company is developing a pain pump, a pump that can monitor pain. So there are some other pumps on the market. However, the pump that they are developing is already a next generation of pumps, which really is the suffering of patients post operations. And these type of companies are get a very difficult time to find money because they don't have a dream or they cannot sell a dream like cybersecurity companies can, or AI companies can, or deep tech companies can. However, they have great products which are very important to have, and they, for instance, have a problem getting funded. So that's why it's very important in which sectors the company is operating. And for some sectors, there are a lot of investors, and for other sectors, there are less investors. But what is let's say common to all the sectors is that the founders need to be very professional, technologically, and also financially.
Mhm.
And that's, I think,
I can
the
completely relate to what you're saying. I can completely relate to what you're saying. I
um,
think it's a great point.
yes. So look, take for instance the Israeli scene. Okay, let's say now that you're a startup and you have some good idea, and let's say that you are able to raise some couple of hundred thousands of dollars. That's what you were able to raise. You brought some money from home. You're a young startupist. Maybe your parents donated something. You have some friends that believe in you. Maybe people that know you. Maybe your colleagues from university, and you manage to get some money to get you going. Now, what are your options in Israel? Okay, what are your options? So, as mentioned, you have some family and friends and fools which believe in you. Fools because most of the startups don't succeed eventually, unfortunately. Um, and then in Israel, you have the Israeli Innovation Authority, which is a very important institution in Israel that supports innovation. It's a governmental institution, but to my humble opinion, it's not budgeted enough. I
Hmm.
just saw that for 2025, they budgeted it for something around $750 million. And I should think that they should quadruple this amount. They should have a 3, 4, 5 billions. They should have 10 million or 15 million, 15 billion shekels to support this. Because the high tech in Israel, it's the locomotive of all the market. And this is where the government should put its money. And unfortunately, they don't put enough money there. So a lot of good startups, very good startups that have difficulties in getting funded are ultimately closed because they have lack of funding. And this is where the government should come and support such startups and as many as possible and come up with very generous plans to support, also to support investors which invest in Israel, to lower the taxes. You don't have to be Intel to invest in Israel. What about other investors that invest here? They also need to get some tax benefits to come and put their money here. So it's a very complicated situation. On the one hand, you have the startup which is struggling to develop and get funded, and on the other hand, you have Israel as an ecosystem that needs to do some measures in order to encourage investors to invest in this market in order to increase the volume of capital in the market. Um, it's a tough business. It's a very, very tough business being a startupist. It's not easy at all, but it's challenging and it's very much rewarding, I
It's a
think.
good challenge. It's a good challenge. It's a
It's
very
a,
much rewarding.
it's a good
You're right.
challenge.
You're
It's very much rewarding because, I think that the startups should not look about their financial benefit at the end of the road. They should enjoy the way. They should enjoy the journey, and they should fight to have a good journey, meaning reaching the milestones, following the roadmap, being flexible, and if they do all that, and with some luck also, and lucky's timing, they might succeed and then also benefit financially. But
Mhm.
it's a very challenging for each
It's a
startup.
very challenging era. Yeah, it's crazy, man. I can completely relate to what you're saying. And, you know, um, we're chatting um almost 50 minutes, and I learned so much about how an investment banker looks at a situation and how he digests the information and how we come up with certain solutions that might benefit entrepreneurs and businessmen who wants to raise money for their own startups companies in any sector, which I think that macro side of the things really helped me um, about everything that I need to calculate for the next time and on to the next journey. And I really appreciate it. Now, one last question. If you were a founder, hypothetically speaking, what would you do differently and how would you operate in order to avoid a mistake that you saw over your journey as an investment banker?
Okay, good question. I've been a founder. I founded 3 companies together with partners. I come from the industry. I was sitting in the chair of the CEO of a startup. I was the one running after investors and try to solicitate them to come and invest in my startups. Um, so I have both perspectives, the side of the founder and the side of the banker or the capital raiser. Um, few tips for the new startups. Um, I think that planning is very important. Planning not only technologically, not only on the possibility of the product or service to work, but startups should really get into a process of doing preparatory work and analyzing uh, exactly the possibilities. So, first of all, if their technology can really mature and succeed, and they are able to develop it. Secondly, the market. They should have a very strong feel on the market and how their technology and their company is going to fit in that market. What part of the market are they going to take, and which market, which cities, which verticals? So many questions which need some answering before investing so much money and time into a startup company. Then, of course, they must make their financing decisions. They have to have a good business plan, a real business plan, not a wishful business plan, but a very practical and pessimistic business plan. So that they can be really ready uh, before they set and start working. And I personally would recommend them to use accelerators. You have accelerators which provide support to new startups on their very, very first steps of the way, or they should have consultants which have experience that will guide them through and help them think, because you have to devote some time to think before you start operating. And then once they have a very good plan in their in on the table, a written plan, a plan that they can always go and update and look at, then they should hit the road, start getting the initial money and start developing. And then once they do, they
Absolutely.
should work with good milestones and a credible roadmap and take it from there. And always not neglect the financial side. It's not enough to develop the product, you also need to finance the product. So you need all the time, once you start to inject money to the company, this is a process that doesn't stop for a long time. So all the time you must be thinking how I'm going to get capital injected to my company. And For all the founders, I can say that this event takes time. Usually, if you want to be on the safe side, plan a year, 1 year for a round to get realized. It doesn't happen in a few months. You have to make good preparatory work before you go to your roadshow, before you start applying to investors. And then you have to take around the year to get funded. I saw some rounds which take 3 years. So it doesn't mean that the company doesn't work, but let's say that if a company is in its seed round, let's say they're looking for $5 million, or in one day they need $10 million. So they need to plan per each million what they're going to do, how it's going to advance them on the roadmap. And they have to have an optimistic plan, a medium plan, and a worst case scenario plan. How are they going to cope with what they're able to raise? And they have to be adjustable and flexible to move between the plans according to the situations.
You nailed that down. You nailed that down. Thanks. Thank you, Eyal. It was a really educative conversation. I shut my mouth for the entire conversation because I really want to absorb as much as I can over a conversation, which I successfully done. And I can tell that I learned so much. And I believe that 100% would be available for the audience who would consistently listening to the TradePod episodes. So I want to thank you for your participation.
Thank you very much for having
Um,
me on your podcast.
it was an incredible pleasure. Thank you.
Thank you. Thank you, Fek. Good luck to all the founders.
Thank you. Bye bye.
Bye bye.